And we are live.
Hello and welcome to Accounting for CEOs. This is the fourth in a four-part series. I'm Julie Cranston, Director of the SBDC at UC Beal Applied Innovation, and I'd like to thank you so much for joining us today. Today's webinar is brought to you by the SBDC at UC Beal Applied Innovation in partnership with TGG Accounting. The SBDC is funded in part by the U.S. Small Business Administration and the state of California. The SBDC is here to help you start, grow, and succeed in your business by providing no-cost expert consulting and training such as this webinar. In addition to our regular consulting on business management and equity funding, we also have been helping our small business clients understand and apply for SBA loans like the Economic Injury Disaster Loan or EIDL program, and also the Paycheck Protection Program or PPP loan. We can also advise on how to administer these loans if you receive them, so make sure to reach out to us if you need assistance. We have a hotline set up and additional resources available. The hotline number is 1-800-616-7232. And if you're a tech or life science business, you can go straight to our intake form at sbdctech.org/contact. We also have a COVID-19 resource guide available at ociesmallbusiness.org, and we'll put all of this information in the chat feature. A little housekeeping before we begin. Everyone is muted during the webinar. Tomorrow, the recorded webinar and a PDF copy of the slides will be sent to all participants. There will be Q&A at the end of the presentation, but please feel free to ask questions during the webinar by clicking on the Q&A box at the bottom of your screen. We may not get to everyone's questions, but we will do our best. If we don't get to your questions, please email hkhaled@fullerton.edu and we will attempt to answer them and get back to you. Our program today will be presented by Joe Johnston, Senior Accounting Manager at TGG Accounting, as well as the Director of Business Development for the LAOC region. During his time at TGG, Joe has supported businesses from the startup size through middle market growth and transaction. While industry agnostic, some of Joe's favorite clients have included medical technology and SaaS businesses. Joe has hosted dozens of technical and managerial accounting trainings for accountants and business owners alike to help them understand the power of operational finance. Joe received his MS in accounting from San Diego State University. Joe, thank you so much for being here today. We have really enjoyed all of these programs, so I'm really excited for the software portion. I'll now turn the program over to you.
Excellent. Thank you so much, Julie. It's been my pleasure to give these over the past month here, and thank you everyone for joining us, and for those of you that have joined us in our past few sessions. As Julie's mentioned, my name is Joe Johnston. I'm a Senior Accounting Manager with TGG Accounting, and I'm very thrilled to be giving you the fourth part series of Accounting for CEOs. Today, talking about software, which I know really drives home to the heart of SBDC and so many startup business owners now. We see so many, I think proportionally with the businesses that I've worked with, I've seen so many more junior CEOs and junior executives popping up through software and e-commerce based businesses. So this is really exciting to get the opportunity to chat about this here with you today. So gang, a little bit of background on ourselves. This is what I looked like pre-COVID while they were still giving out haircuts. But through my work at my firm, TGG Accounting, to give you a little background on us, TGG Accounting, we worked in the managerial accounting and business consulting space for the past 15 years. And over that time, we've worked with upwards of 1,000 clients, ranging from industries from manufacturing, software, government contracting, service businesses. Really, we've worked with so many businesses from the startup size through middle market growth. And our work very much so surrounds helping business owners and executives run their businesses by the numbers so that they can feel more comfortable making decisions and really driving themselves towards their goals. Now, for some key takeaways from today, we're going to be following the same model that we have for the past few weeks here. We're going to talk about breaking down the characteristics of a software business from an accounting perspective. We're going to then move on to talk about how you can compare your software business to others using the TGG Way basic business model, which is going to allow us to cross-compare your business and performance and how it's performing in cost of goods sold and its operating expenses to others in your market, even though they're maybe using a completely different software and different product. We're going to take a look at that in the context of the price value matrix. It's going to help us figure out what your positioning is and what your branding is in terms of spend. And then we're going to dive right into some best practices for financial reporting and give you some great KPIs that we can walk out of here with to start tracking performance in your business and give you some information on how you can utilize those. So to start out going through our characteristics of the software space, we want to break this down as simple as possible, right? We have to start from the ground and build our way back up. The baseline expectation is that we need to make sure that we start out with a great piece of software that people want and that people are going to adapt. Whether we're on a single service sale product business, or if we're going to start a SaaS-based model, we need to make sure that our product is adaptable, because we're going to have a heck of a lot of front-end costs in producing and developing this thing. Then we're going to move on to making sure that we're acquiring new customers, tracking how much it costs us to do so, and what the shape of our customers really look like through extensive analysis that we'll be diving into throughout this webinar. And then making sure that we're retaining customers if we're going through a SaaS-based model and tracking through our MRR and our ARR, which is monthly recurring revenues through our SaaS model, and our annual recurring revenues through a potential SaaS model. Now, let's take a look at what does a software business really look like, right? From a business consulting perspective, a software business really has two dimensions to it. One that is universal to any software business, which is the development company, making sure that we're front loading all of our costs, producing a good product that's going to be usable, going to be adopted. It's going to address the customer's concerns. It's going to be something that they actually want to use for the benefit. And then the second piece of this is really looking at a distribution model, a distribution company, which it says, how do we want to get our product out to the world, and how do we want to sell it? How do we want to market it? A SaaS-based model is really our ability to lease a product, right? Lease our software, typically using an online-based platform, a web through web hosting. Think of Netflix, Hulu, Spotify. All these are our SaaS-based models where we're paying monthly subscription fees. In this other case, the other direction that we could go through a distribution model is through single-purpose sales, selling our software as a product. In this case, you can think of something such as video game software or Windows, which will still be updated continuously, but it's sold to, say, a computer manufacturer to be installed on their products outright for every single piece of product. This is going to affect how we're going to be looking at acquiring customers, reviewing financial performance, budgeting, and quite a few other factors throughout our business. So let's dive in. When we're looking at a SaaS-based model, comparing this to a product-based model, a product sale-based model, a direct software sale-based model, we're going to have slightly less front-end costs in product development. Now, that's not to say that you're going to have low product development costs, but let's think about this objectively from a business owner perspective. If I'm producing a product that I am attempting to sell outright, then I need to make sure that that thing is as turnkey as possible, that it's adoptable, that it's going to address customer concerns, it's going to be usable, and it's going to make my customers happy and give them the value that they're looking for from that product. If I'm entering into a SaaS-based model, we can get an operational, developed, functioning product that's available for customers to utilize. But I don't necessarily need to go through every single tick and tie through my development process before it's deployed to start getting customers in the door. We can develop through stages. Throughout a software as a service business model, we're going to have a continuous sales analysis process. When this happens, what I really mean by this is throughout the course of our SaaS-based model, we're going to be observing what are the customers that we're bringing in, what's our price positioning, and how are our customers responding to increases and changes in price. Something we'll be discussing near the end of this presentation is if we're able to raise prices on our software without actually losing any customers, then I'm willing to spend all the money that I want to on customer acquisition costs to bring in new customers and really pump lifeblood into my business. As a SaaS-based model, we're going to have continuous development in software costs development and support-based costs to keep the environment running at full speed. And we're going to have slightly lower risk as it relates to our product as a whole and our business entity as a whole, because we're going to have the ability to add in new features and benefits to our existing SaaS-based model, as opposed to your software product-based business that's going to be expected to be quite a bit more turnkey out of the box with a single payment. Now, in this base model, SaaS-based businesses, of course, have many keys to success, but here are a few that we're going to be focusing on, which is really having success, a lot of effectiveness and a lot of effort going into analyzing your sales model and the effectiveness of changes in pricing on how we're going to be going through customer acquisition costs. How much does it cost me to acquire a small customer versus a larger customer versus a mid-sized customer? And what is our churn in those various areas? And of course, looking at our sales effectiveness throughout different sales distribution lines. Looking at a software product business, as we discussed in the contrary, we're going to have higher upfront development costs to ensure that our product is turnkey on the front end. Now, what that means is, so to say, if you were in my industry and you bought QuickBooks desktop accounting software, my expectation is that it's going to be functioning, it's going to be working. Not that there's going to be continual patches and updates. Now, those things may be provided from a software business as a part of a customer service guarantee or customer service process, but it's not quite as expected as in a SaaS-based environment where you're going to be expected to provide continuous support and development service to keep the operational environment running. Because of this, there's quite a bit of higher risk related to a software product-based business in a single sale, but there's also the potential for higher reward. When you create a product you're going to sell outright, you can sell for quite a bit of a higher price because it may end up being customized for that business. We can help increase our ability to bring in new customers with this software product type business, depending on what your software is, by providing an option for installation and customization. In a software product-based business, quite a bit of our success will be helped by having a good and adopted product on the front end, ensuring that our sales strategy is built to beat out comparable SaaS-based products, and also making sure that we're providing support and we're showing the value of that support, which will be contrasting against SaaS-based products that will be providing that regularly. So let's think about these businesses from a startup position in pre-revenue. As we touched on a bit before, there's quite a bit of high startup costs that will need to be financed through development. Well, in a traditional, if we were talking about a retail-based business, we were talking about a product, a single inventory-based business where it already exists. I know that as soon as I buy that inventory, I can go out and sell it. And that turn might be very quick. In a development space, I'm going to be pumping in a lot of cash and a lot of funds to get a product ready to go to market, whether it's SaaS or whether it's going to be a single product that I'm going to have to finance on the front end before I have something that's really ready to sell. In the software product-based space, we're going to have this higher risk because we're betting on the adoption of the product. But in the SaaS space, that product can get us 90% of the way there, so long as it is able to attract customers that we want to bring in, and we can continue to add features and benefits to that SaaS-based software over time. Another characteristic from an accounting perspective of these software-based models is deferred revenue. Now, what this really means is that if you're going to be attempting to provide a software service to a business, to an organization, to the government, whatever that might be, and we're going to be providing them a 2-year contract, 3-year contract with prepayment on the front end, then really what we have is we have a huge liability in our books. We may have received all of the funding related to this contract, but on the back end, we need to make sure that we have the cash flow available to service that contract over time. Where we've seen failure in businesses in some of these SaaS-based, contract-based models is when they're able to acquire huge amounts of customers and they're able to sign these multi-year contracts, but they don't actually have any ability to service them because they're distributing out cash to the owners, or they're utilizing it in ways that aren't generating more customers, and they're building what would eventually be a bigger service bubble to be provided. Now, because of this, and because of some of the risk associated with deferred revenue at long-term contracts and SaaS-based models, from our experience, we've seen quite a few venture capital partners that typically require GAAP-based accounting and financial reporting for businesses that are going to be servicing these types of contracts. GAAP-based accounting in this case means that we want to make sure that we're following generally accepted accounting principles in the US. Those may be simplified in the startup environment and in the middle market environment. It's not going to be as complicated as doing this for Amazon Web Services. But we need to make sure that we're following those concepts to report financial performance and the obligation on those deferred revenue contracts over time. We need to make sure that our business is coming out safe and on top. Once a business is in revenue, one of the beautiful things about this is if we have a service-based contract software business, we're going to have a negative or minor operating cash flow cycle. Now, what that really means is on that front end, we're going to be receiving the cash related to these contracts, and then, which means we're going to be funded right from the start. As soon as we're going to spend quite a bit of financing getting our product developed, get it out to market, and then from that point forward, we're going to be funded on the front end before we actually have to go out and provide our services. Now, in this case, we need to make sure that we're budgeting for, of course, sales growth, but really that we're planning out for what it's going to cost us to provide that support and service over time. Because if we set up a contract based on an assumption of what we think it's going to take us to service it, and we're wrong, we could end up losing quite a bit on that contract. So we need to build in some margin of safety to make sure we're protecting the business. Now, I'd be amiss when we're talking through the software industry if we didn't talk a bit about R&D tax credits, something that I know the SBDC is very familiar with. Now, we're going to touch on this a bit just to give you some general concepts and some tools that you can utilize to really track your research and development for your software-based business coming out of this meeting here. So first of all, a little bit of background on the R&D tax credits. Tax credits themselves are dollar for dollar reductions in tax. What that means is that if it's not about reducing taxable income down to a lower level, it's not about reducing another factor. It's saying that if you owe $10,000 in tax and we have a tax credit, I can apply this directly against it to reduce my tax figure. Tax credits are the best outcome or a great outcome from a tax strategy. These R&D tax credits can be used on qualifying salaries, such as W-2 wages that you're paying yourself, paying employees, from supplies and materials that are used for research and development, for contracting research, as well as for computer leasing. At the end of the day, when we're thinking about an R&D tax credit, what we want to consider here is that we have a qualified expense, such as those listed above, for a qualified activity to get us a qualified cost that we can consider towards our R&D tax credit qualification. At the back of this webinar, or excuse me, in this component of the webinar, after this is printed out for you, you can take a look at quite a few of the qualifying expenses that you can utilize for your R&D tax credit. As it relates to an R&D timeline, we're typically looking at this in 3 stages in ordinary business. On the front end, we have research, which is saying we're searching for knowledge, we're doing research, we're trying to figure out what it's going to take. We're talking to our customers to figure out what product, what service do they want? What do we think is actually going to be a significant improvement to our existing software? All of this process is considered our research stage. We haven't quite figured out what we're going to make yet. The next stage is really talking about development. From the moment I know what we're going to build, we're turning that research into a plan. And we've documented that plan, and we're going through actual developmental steps to create that new product, that new service, process, or that significant improvement to your existing software. And at the ending of this stage, as soon as after we've created our plan and we worked through development, we've applied all of our labor to it, we've had our technicians, our computer experts, our software experts building this product, we're going to end up with something that's actually commercially viable. It's technologically feasible, which means to say we have something we can go out and use. And this becomes our asset in use. It's no longer R&D at this point. From this point, what we're going to do is we're going to be putting all of these costs on our balance sheet for our business, and we're going to be recognizing it as an intangible asset in use. Now let's talk a bit about commercial viability and technological feasibility and what that really means. So what we want to think about here is that something is technologically feasible. It's commercially viable. What we're producing is not really a prototype anymore, right? We have software that we can deploy in this case. If we're talking about other components of R&D, this could be inventory that's ready to be sold. It's a fixed asset that's ready to be used, or a process that can be utilized in a chemical engineering setting. But prior to us reaching technological feasibility and commercial viability, we're very typically going to be expensing, meaning that we're not able to capitalize on our balance sheet all of the expenses related to research and development. Because at this point in time, the cost from an accounting perspective, we have what's called the matching principle. The matching principle says that we want to align expenses to the point that we get their benefit. And if we're paying money for, say, wages for my development people that are really going to be producing this final product, that's going to become for me a future benefit that I can utilize. And we want to make sure we're capitalizing those items. So if there's not an expected future benefit to our expenses, to the wages going in and the efforts going in, those are not going to be considered an asset, and we're going to expense those directly on our income statement. But if we have an expected future benefit from our development work, from our product that's now in technological feasibility, then that's going to become an asset for us that we can put onto our balance sheet. Now let's talk a bit about internally developed research and development. So this is going to include all of our software that we're going to be using externally and selling. So in this case, we're going to include costs of wages, costs of items for maybe computers or hard assets that we needed, PPE, to actually utilize our software. And for the treatment of these costs, we're going to be expensing these as incurred, as we mentioned, until they reach that technological feasibility stage. When we're looking at software in a general sense, software is going to be utilizing this three-stage approach, which is our preliminary stage, where costs or expenses incurred as we're searching for ideas, we're talking to customers, we're figuring out what they want, what's going to be part of our end product. You know, should we develop this? Should we not develop this? We don't really have a plan yet. From that moment, we're going to get to what's called our development stage. We have a plan in action, and we just need to build the darn thing. As we're building our software, as we're adding and writing code, we're testing it, we're working through it, we're improving it. All of our labor costs of your people, of your technology that's going into that can be capitalized to your balance sheet for the purpose of R&D. And then, of course, as we get out of our development stage, we're going to get into what's called post-implementation, which is really just making sure that our people know how to use everything, that our teams are able to run the R&D month over month and improve it and keep it in good shape. All of these are going to be expensed on our income statement. If you believe that you're a software business that is going to be continuously creating new products, or you're going through this development stage right now, one of the simplest asks that I can make of you is to say, document the dates, your start and stops of different processes. So to say, as of this date, we came up with a clear plan for what our product is going to be, and we began the process of attempting to develop it out. We had employee A, B, and C working to develop it. And here were their wages, here were their timesheets, and here's all the proof to say this is the effort that they were going through. By tracking all of these expenses and the inputs into your process, you can maximize your potential for an R&D credit and make sure that you're accounting for it correctly once your product is already in service. As we mentioned here, for reference later, I've included a list of quite a few items that you can include in research and development, including laboratory research. If we were in the biotechnical space, we could put in testing and search for other evaluation of product and process alternatives, et cetera, and quite a few others. So I'm going to leave this in here and you can take a look through this later. Now that we've driven through the characteristics of the software model and talked a bit about the R&D tax credit, let's circle back up to the TGG Way basic business model and the price value matrix. Now, for those of you that haven't joined us in the past few weeks, the TGG Way basic business model was created over the course of the past 15 years to provide business owners a method to compare their company's performance to others in their industry. Now, software businesses are not new, software product businesses are not new, and SaaS businesses are not that new. And there's plenty of enough information out there on them to see how they're performing in an optimal environment. Now, with this information that we've been able to collect from looking at our own clients and looking externally, we've been able to figure out what's the ideal performance of these businesses from what's called a common size analysis view in this basic business model. To take a basic business model and to examine your business through it, what we really want to do is take your income statement and start out with every item as a percentage of revenue. So to say, your revenue is 100% of itself. Your cost of goods sold, or cost of sales in this case, is going to be maybe 50% of that if it's half of your revenue costs. Your gross profit, which is what you're making off of the cost of your, the net between your revenue and your cost of goods sold is going to be 50% of that amount. Your sales general administrative is all of the effort that's going to the back office, all of your accounting team, your tax support, your legal support, all the support related to selling your product. That is going to be going to your SG&A to get you down to what's called your net operating income, your take-home profitability from your business. This is how much you're going to be able to make on a recurring rolling basis. What we want to be able to do with the basic business model is take your business and compare it to how the basic business model is shaped to look. So in this case, if we see that the basic business model for a service-based business has a 50% gross profit, and your business is really running at 40% gross profit, what that means is that, you know what, maybe we're paying our people too much. Maybe we're not charging enough for our services, which is why our revenue is not high enough. But if we take a look at the impact that that has on our profitability as a whole, we've just driven what it would have been a 10% net profit on our business down to zero, barely to break even. That's the importance and the relevance of this basic business model. Now, when we're considering the basic business model, we have to look at it in the context of what's called the price value matrix. For your product and your service, whatever that might be, we have to consider, are we high value and high price, or are we low value and low price? So let's think about what that really means. In my industry, on the accounting side, a high value, high price service may be something such as NetSuite. It's a very complicated, technologically advanced accounting software that's available for businesses. Very large organizations use it. And then accounting softwares that you may have heard of and those that we use for smaller and middle market businesses will be something such as QuickBooks. The difference between these is how these businesses are presenting themselves and the value proposition that they're bringing. NetSuite is able to charge tens of thousands of dollars for their software service because they know that they're high value. They're really able to help businesses. But QuickBooks is more so on the low value side. Really, they're saying that our software is easy, it's accessible, but you can't do all that many complicated things on it. We can't do a lot of advanced inventory tracking, assembly building that's going to become quite tough and tedious, or logistics maneuvering through the ERP. Now, what that means though is that they're not positioning themselves to be high priced, they're positioning themselves to be easy, convenient, and cheaper than NetSuite. But what we really want to do is for your business, we want to make sure that you're living in this sphere right here. Because as long as you're living in this sphere, your business can be profitable, your business can make money. Let's think about this objectively. If your business is high value, high price, you can go out and sell the quality of your business all day. If you're low value and low price, then really we're becoming a cost cutter. We're going convenience. And we're trying to say that we're saying that we're easy and we're accessible. And we can still make money through that. But if we say that our business, our software product is low value, high price, no one's going to buy anything from us. And if we're high value, low price, we're not going to make any money because we're going to be pumping all of our costs into product development and we're not going to be selling it for enough. So we need to make sure that our business is living within this sphere relative to our industry. So let's take a look at the basic business model for the software industries. So in this case, on the left side, I have a product-based inventory, a product sale-based software business. So to say that we're making direct software sales one time. In this case, on the front end, we're going to have a 25% cost of goods sold, getting us down to a 75% in gross profit. The reason for that is that we're pumping a lot more activity into making sure that our product is in really great shape as we're going out and we're selling it. We need to test it that much more. We need to run through it that much more. We need to make sure it's that good of a product before we go out and sell it, because once we sell it, it's gone. Now, in this case, we're going to have a very high SG&A, sales, general, and administrative expenses, going from 40 to 50%, with 25% of that going directly into sales, most likely. Now, the reason for that is that unlike a SaaS-based model, in a direct sales software model, we're going to have a different sales strategy. We need to acquire new customers that require the service that require our product, and go out and acquire new customers every single month. This is going to get us down to a net operating income of 25 to 35% for a software build and sale business. Now, these business owners are going to be able to enjoy a much higher net operating income than, to say, a service-based business, because they're accepting so much more risk that the fact that their product is not going to be adaptable. So when you're building out software for direct sales, it's so important to get a product that's going to be adopted, that's going to be valued by your customers. But because of that, we can charge a higher price, and we can come out of this on the other side with a greater net operating income. In a SaaS-based model, we're actually going to have quite a bit lower cost of goods sold. Our cost of goods sold in this case are our hosting fees, our costs going into making sure that the environment is running on an optimal level and that we're able to actually continuously provide our service. Once we have these processes developed, we can just continue to run them and make sure we're running technical specs. Now, in this case, cost of goods sold is not talking about including additional features, additional benefits. That's not in cost of goods sold in this case. But in the SaaS-based model, we're gonna get a huge gross profit of 90%, coming out to a sales general administrative cost of 70%, which is going to include quite a bit of additional cost in customer acquisition, making sure that we're tracking through and performing analysis in our business, and that we have the administrative ability to continue to run our software and our support. Now that we understand how our business should look, and we've thought a bit about where our business lives in the price value matrix, let's talk about a few different items that you can look for on your income statement. In a software-based business, your income statement is going to be relatively ordinary except for a few different items. One is that you're going to have unique components of cost of goods sold that we want to make sure are categorized correctly. And the second is that we're going to have less importance surrounding a very common financial metric that you may have been presented with before, called EBITDA. For many other businesses, EBITDA is considered a valuation metric for how your business is performing. But because of the layout, the financial layout of software businesses, EBITDA becomes less important. And let's talk about why that is. It is related to your cost of goods sold on your income statement. Cost of goods sold for a software-based business is going to include hosting fees related to keeping your operating environment running, and all of the direct labor related to keeping our software running, keeping our environment running, making sure that our customer success and experience for existing customers is continuously available, because that's part of the product that we're selling, is the availability of our service folks, and that we're delivering ongoing product service. Now, in this case, we're also going to be including the cost of any third-party software that's necessary to support the environment as it exists right now. Now, as we discussed in our R&D section, cost of goods sold will not include producing a new product or service. If I'm generating and this objectively makes sense, right? If I have customers that are using my SaaS-based model, my SaaS software, and they're paying me out every single month, they're paying for me for the product as it is, and the customer service that's available to them to support them using the product as it is. If I'm creating a brand new product or service, that's going to be going through our research and development accounting stages in a totally other area of the financials. And we want to make sure we're tracking that separately so we really understand performance of the business and performance of the model separately. So let's talk a bit about EBITDA, as we were talking about just a moment ago. EBITDA is a very common financial metric that's used to look at businesses objectively and determine sometimes operational value. EBITDA means earnings before interest, taxes, depreciation, and amortization. Now, what this really means is that businesses are taking what is net income and they're adding back interest expense, tax expenses, and then these two accrual accounting concepts, which are depreciation and amortization of heavy and hard assets and intellectual assets. But when we're thinking about a software-based business, if you're considering to run a software-based business, or you are already running one that's in the legal shape of an S Corp or an LLC, all of your taxes are getting passed through the legal entity and getting distributed to you, which means that your business is not going to have any tax expense. And as we discussed earlier on in our development stages, if your software business is already in operations, we're going to be in that very short cash flow cycle that's going to be giving us funding on the front end of providing our services, right? Even if it's a month-over-month SaaS model, we may be getting paid on the first day of the month before we actually have to provide the services for the rest of the month, meaning that our need for financing and for cash flow really may not be all that high, which means we won't have that much interest. So in this case, the only things we'd really be adding back would be these accrual accounting concepts, depreciation and amortization. So for this case, looking at EBITDA really becomes less important for a software-based business that is getting ready to go through valuation and transaction. Now let's talk about your balance sheet for a software-based business. Something that we've touched on quite a bit here is looking at deferred revenue, which can be a very significant liability for software-based businesses that are doing service-based models. So in this case, we're receiving deferred revenue is the revenue and cash flow that we receive from customers on the front end of providing our service before we actually have to provide that service to them. This can be the case if we're invoicing at the front end of the month and we have to provide our service through the end of the month to make sure that we can afford to provide that service, or if we're in a longer term contract environment, 1 year, 2 years, 3 years, whatever it might be, to make sure that we're going to have all of the revenue related to those contracts when they're recognized in that, the cash from those contracts received on the front end of our financials when everything is received. And we're going to be recognizing that revenue progressively over the period of the contract term. So let's talk a bit about key performance indicators and some financial metrics that can be really useful for your software-based business. And we'll talk a bit about how you can utilize these. So here's a few that we're going to be chatting through. Retention and churn, ARR and MRR, annual contract value, and quite a few others here. So first, in looking at retention and churn, when we're thinking about our SaaS-based model, Our goal is to make sure that we're keeping customers retained within our business so that we can keep them on this subscription service. We can continue to collect revenue from them on a monthly basis. So for that purpose, this will be a great test for us for our ability to demonstrate value, whether that's through the product or through customer service and combination of an internal sales. So what we're going to look at is retention. The way that we're going to calculate retention is really saying how many customers did we have over the course of a whole period of time, whether that's a year or a month, and how many customers do we have at the beginning of that period. Churn, in this case, is going to be the opposite. How many customers did we lose during that period of time? How much business did we lose because we couldn't continuously demonstrate value, or there was another comparable business that swept up some of our customer base, or whatever that reason might be. Next here to look at is ARR and MRR, which are great tools for valuation. Now, when we're talking about annual recurring revenues, this is going to tell us what amount of revenue we can expect during a year based on subscriptions. To get this value, what we're going to look at is what are the value of all of the subscriptions we receive during the year? Then what is the value we're going to be adding in all the value received from additional up purchases, up sales of additional software provided to these customers, and then remove revenue lost from cancellations during that period in the churn. This is telling us how much revenue we're anticipating to receive during a period of time based on an expected churn rate, based on our expected customer acquisition, and our ability to sell and upsell customers that are using our service if we're providing additional support in that model. Your monthly recurring revenue is really your same piece of information, but broken down to a month-over-month level. And your formula is going to be going through the same direction, going through the same methodology, just utilizing a month as opposed to years. Now, another tool that we really love to look at is annual contract value. And the reason that we talk about this, so many of the KPIs associated with a software-based business are related to analyzing sales, analyzing who's our customer base, how much should we sell them, who's coming in, who's leaving, right? If we already have our product and we know that we can support it, I'm just going to be punching so hard into sales and marketing analysis to figure out how I can bring in more customers, right? So when we're looking at annual contract value, this KPI is going to be used to help us understand what our customer base is buying, in the sense that are they buying our low-level contract, our mid-level contract, or a high-level contract, if you're providing those available for your customers in terms of service. Now, depending on the type of business that you are, if you're Amazon Web Services and you're servicing, $100 million businesses, you may have a very high annual contract value, because those contracts, you're going to have fewer higher dollar contracts, maybe not in Amazon's case for fewer, but they're going to have higher dollar contracts out there. But you could still have quite a bit of great profitability even if you have lower annual contract value. Let's think about something that has a very, very cheap benefit, such as like Spotify. We can still make great profits, but in this case, we're making them through customer volume, not through the size of our individual transactions. So when we're thinking about our business value, when we're thinking about how we're positioning ourselves to customers, and we're looking at annual contract value, we can do all this analysis to understand the sweet spot for our business and who's the perfect customer for us to access. When we compare this to CAC, we can view what sizes of customers we're working with, what sizes of customers are beginning to come into our company, and how much it costs us to acquire those contracts. When it comes to Spotify, all they have to do is put an ad in front of you that says, "Do you like music?" And you click yes, and then, I pay $15 for Spotify, right? But if I'm talking about Amazon Web Services or something that's going to be higher dollar, higher value, then, it might take a lot more of an involved sales process. So understanding what your customer acquisition cost is going to be related to different size customers and contracts is going to make a huge difference. So with all that reference to CAC, I have to actually talk about it, of course. So CAC, your customer acquisition cost, is another sales analysis tool and value add analysis tool. It's used to determine the effectiveness of marketing and sales techniques. We're going to figure out what's our best annual contract size based on how much effort it takes us to close different contracts, and what sales method is working for us. In this case, we're going to be looking at our sales and marketing expenses that we put forth during a month, whether that's looking at an SEO, or we're looking at actual individual salespeople or ads or click pay ads, and figuring out how many customers we're able to acquire using those methods. Now, when we're thinking about CAC can get very complicated depending on the timing of your sales process and how long it takes for someone to go through the process of getting marketing and sales in front of them and actually closing the deal. If we're in a space that has a very low customer annual contract value, then it may be the case that we have a much tighter customer acquisition time period that we're going to be utilizing. So for that reason, I could look at really the marketing expenses and the sales expenses that I put forth this month and compare that to customers that I've acquired this month. But if your sales deal flow timeline is 30 days, 60 days, then we need to make sure that we're adjusting CAC and we're time adjusting what expenses we're looking at to really compare to the amount of customers that are coming in through our pipeline. So a lot of sales analysis here that we're going to be exhibiting through CAC to make it worthwhile. And this is really all going to be involved through understanding the timeline of your sales process. Now, similar to customer value here, we're going to look at customer lifetime value. How much revenue does a typical customer bring in, right? The easiest way we're going to look at this is we're going to flip over our churn rate. We're going to take our average revenue per account, figure out how much revenue we're bringing in for each of our customers, and really multiply the two here to say how much revenue are we likely to get from our customers with consideration for our churn rate. Now, when we think about customer lifetime value, well, as we're looking through all these different sales monitors, we want to compare gross profit margin relative to churn and pricing. So to say, let's think about this here. I know that sounds complicated, but what that really means is how sensitive are customers to changes in pricing, right? If I increase my prices, 5%, how many customers would I lose? How many customers did I lose? If your customers aren't that susceptible to price changes, then increase your prices, right? A few years ago, Netflix increased their prices from, I want to say it was like $8 a month to $11 a month. And I'd be curious to hear how many people in here actually unsubscribed for that reason, right? We're very, I would say that we have a very elastic demand curve. So to say that maybe we'd accept quite a bit more in that case. So if you're looking at your customer lifetime value and your churn, keep an eye on how customers are responding to changes in pricing and really what you think they'd be willing to accept. If you're in a software business, a SaaS business that's been in operations, and you've been in operations for quite a while, maybe take a look at, is it the right time for a price increase potentially? Any price increase is going to go directly to your bottom line because it doesn't affect the cost that it takes for you to run the environment, and it doesn't necessarily affect any of your sales marketing expenses unless it's going to increase your CAC in this case. So this is speaking to those same points that we were just discussing. If you have Netflix, Amazon Prime, Disney Plus, these guys are going to have quite an elastic demand sensitivity curve. So to say that customers are going to be willing to pay more to get the same service, and because we want it that much. So when we're thinking about our business and we're thinking about CAC and all these various sales metrics and all these various financial-based sales metrics, we also want to think about how long it's actually going to take us to recover our customer acquisition costs. So to say, how many months of financing, hypothetically, is it going to take to grow my business, right? So what we're going to do to run this formula is to say, we'll take our customer acquisition costs, the cost that it takes for me to bring in additional customers. We'll divide that over our average revenue per account times our gross margin percentage. And this is going to tell us how many months we really need to fund to go forward and grow our business. So again, I hope that you got some fun takeaways from today. I know we covered a lot in the software space. It's such a huge environment, from software direct sales to SaaS and so much more. But I hope you got some great takeaways from today, including the characteristics of software, our models, and getting into some best practices and KPIs. Thank you for joining us, those that joined us earlier in the series. And if you have any questions, always happy to chat, connect through LinkedIn, follow us, TGG Accounting, and we could talk a little bit about your industry specifically in your business. With that, I'll go ahead and I'll take a few questions here again.
Thank you. We do not have any questions currently. Maybe people are typing them up. Julie, if you want to give some remarks as we wait for people.
Okay, that sounds great. Joe, this has been a phenomenal series. I know that we've been getting such amazing feedback from all the different silos. So thank you again for all the work you've put into this wonderful webinar series. And also to TGG for all of your support of the SBDC and our clients in our community. Thank you to everyone else for joining us today. Again, you'll receive the recording and slides tomorrow via email, and we'll plan to present additional webinars on topics of interest to tech startups in the coming weeks. We've got an IP series running monthly now, and stay tuned for our Women Talk Tech series. It's coming in October. Last year that was a conference, and we're moving it to webinar format. So really excited about that. Looks like we have a couple questions. One question in the Q&A box: how to treat maintenance on a software sale. Joe, do you have any thoughts on that?
So if we're talking about maintenance on your software, right? So any expense that's related to maintaining your software environment, that's keeping your existing SaaS environment running, is going to be cost of goods sold, because that's what people are buying. Your product is the software that already exists that you're leasing out to customers effectively through that SaaS-based model. But if we're going to be putting in time and effort to just maintaining that environment, that's going to be our cost of goods sold.
Okay, it looks like we also have initial sale plus annual maintenance. I don't understand this question. Initial sale plus annual maintenance, 20%.
Yeah, I'm not sure to make of that.
Can you
Peter,
read it?
Sorry. But Peter, I'm very happy to connect outside here if you have a more direct question as well. Very happy to see if we can assist.
Yeah, anybody, if you have any questions that come up after this webinar, Joe's always happy to take questions offline. So please reach out to him. And it looks like we don't have any more questions.
Absolutely.
But,
here is that email address again, if you did have a question then you wanted it specifically addressed.
Okay, great. Fantastic. Well, thanks again, Joe, and everyone for joining. If you'd like one-on-one consulting for your tech or life science business, please go to sbdctech.org or go to the 1-800 number in the chat. And we're here to help you and your business start, grow, and succeed. Thank you so much for joining us. Stay safe and healthy. Thanks, Joe.
Yeah, take care, everyone.